Have you heard the story of Ronald James Reed? He was a janitor and a gas station attendant who, at the time of his death, amassed a staggering fortune of $8 million. So how did a blue-collar worker amass more wealth than 99% of people? He did it by investing long-term in the stock market and avoided taking positions in companies that he did not understand. He was a patient investor and lived frugally. And he was generous. This humble gentleman willed $1.2 million to his local library, $4.8 million to his local hospital, and another $2 million to his family. And we at Flank don't think that Ronald is a one-off market genius. The market can seem intimidating and overwhelming, and we think this is partially by design from people who benefit off of investing other people's money or are trying to sell get-rich-quick schemes like Forex trading, crypto ICOs, day trading seminars, etc. The truth is, investing is a skill that takes time and effort to develop. It also requires a high degree of emotional temperament, namely patience, just like our man Ronald showed us. In this video, we'll cover a no-bullshit approach to actually getting started in the market. Of course, nothing in this video is financial advice, but what is financial advice is that if you are ever in doubt, hire a financial advisor. Please make sure that they are a fiduciary, which means they can't sell you anything and are legally obligated to manage your money for your benefit and not theirs. Let's dive into it. Alright, the first step into getting started as an investor is to decide what type of investor you want to be. The two most basic choices are, do you want to be a passive investor or an active investor? The good news is you can be both. In fact, I do passive and active investing myself. But for now, we'll keep them separated and we'll start with passive investing. Passive investing is a strategy where you know that most people and institutions don't beat the market. So you say, F it, I'm going to put my talent and energy elsewhere and I'm just going to try to match the market. The two most basic components of this approach are always be buying so that you don't try to time the market, and to never select a single stock and instead go for low-cost ETFs or mutual funds. And this will work out really well for you. The fact is, despite raking in billions from hopeful investors, most actively managed funds on Wall Street fail to beat the S&P 500. And this is even more true in the long run. This is so true that in 2007, Warren Buffett offered a bet that he put $1 million on. And that bet was that over the course of 10 years, an S&P 500 index fund, the one he chose was ticker VFIAX, would beat any hedge fund during that same period. And someone took him up on it, a hedge fund manager by the name of Ted Seitz. But Ted did do something wily. He chose a fund of funds, thinking that there would be a little bit of alpha generated from that. Well, it didn't work out for him. The S&P 500 crushed the fund selected, so much so that Ted gave up 2 years short. During the period 2007 to 17, the S&P 500 returned 125%, whereas the professional asset managers only netted 36%. And this is because of the fees associated with these hedge funds. Fees are the worst friction for you as an investor. If you take away nothing else from this video, please remember that high management fees are the absolute worst thing for your financial future. Let's go to a compound interest calculator to see how corrosive fees actually are. We're in NerdWallet's investment calculator, and you can go into their balance. And now, this would be a passive investing approach. If you were to take an initial investment of $10,000 and add $500 monthly, and you get 40 years, that initial $10,000 balance would be worth almost $4 million. This would be the S&P 500's historic return, which it's been doing this for about 50 years, and it's this simple. Now, if you take hedge funds' normal fee approach, which is called the 2 and 20, that means they take a 2% fee regardless on if they make any money for you, and then 20% of all future profits. So you'd have 2% automatically taken off, so that's taking you down to 8.15% in this case. Just that one thing cut your return by half. Just a 2% fee. And that's not counting the other 20% they're going to take from your profits. So they're going to take from your profit 20% of that 10%, which is another 2%. So then you're down to 6.15. So your original $4 million return is now $1.153 million. You're at 25% of where you would have been without them. And this is assuming the best case scenario. Remember, most hedge funds do not beat the S&P 500. I hope that proved to you that passive investing is a completely acceptable strategy. We'll go into why I think active investing can be useful for some people, but active investing is a skill that takes dedication to develop. If the idea of studying businesses makes your eyes glaze over, then it's a really good idea to hire a financial advisor. Just again, please make sure that they are a fiduciary and buy low-cost ETFs that index the market, like SPY, which only has an expense ratio of 0.0945%, basically zero, and how we ran that simulator. But the rest of this video will focus on active investing because it's what I love and what I'm really passionate about. Active investing is simply stock picking with the goal of beating the market. But if passive investing will normally beat active investing in the long run, why on earth would we even consider active investing? To answer that, I have to be completely honest. I think that around 70 to 90% of people should invest passively. And I have to admit, I have bias here. I find the markets absolutely fascinating and have gained so much from them that I'm literally starting a company that makes it easier and less lonely to invest actively. But I still believe that most people should not do it. When I started investing, I got started actively investing, but over the years have diverted a portion of my capital, about 2/3, to passive investing. It helps me sleep better at night. And I'm not sure that if I hadn't started with active investing, if I would have gotten so disciplined on investing in general. Passive investing just doesn't hold my interest in the same way. It is kind of boring, but it is helpful. I find it fun to study companies and try to beat the market. I perform the market almost every year that I've been investing. If we remember how much fees can hurt you, we can also look at how much alpha helps. Alpha is the difference between the market return and your return. Going back to our investment calculator, we can see with the same approach of $10,000 and $500, and we're back without any fees, so we're at 10.15% again. Let's look at how just a little bit of alpha can lead to pretty drastic returns. If you think you can beat the market by just a little bit, say 12%, you've again almost doubled your return at $7.47 million. That's if you only get 2% of alpha. Now, if you think that you're a pretty good investor and you have a knack for it, and I'm going to be honest, this is what I target and what I think I can hit, and what I have hit over the past 10 years is I've been compounding at 15%. Again, this is an illustration of showing how much dollar cost averaging plays in and your initial investment. But you can see that how much your returns start outsizing with just a little bit of alpha. Just as a fun thought experiment, what do you think Warren Buffett has compounded at? He literally was the richest man in the world before he started giving his money away. Do you think he's compounding at 50% year over year, 70%? He's the Michael Jordan of investing, so 200% year over year? To become the richest man in the world, all he has returned is 20%. Actually, if we want to be nerdy, 20.1%. But he's been doing it for about 60 years. And the funny thing is his initial investment wasn't much more than this. It was about $100,000 from family and friends from when the Buffett Limited Partnership started. He's obviously taken on additional capital since he started, so this additional investment contribution would be significantly higher, but you get the point. And so I think two things can be true at once. I think that most people should passively invest, or at least have the majority of their portfolio passively invested. But I also think there's value on learning how to invest. And I also think that there are a lot more Ronald Reeds out there than Wall Street wants us to believe. With the rise of Robinhood and people picking stocks, oftentimes without studying the companies, which we're trying desperately to change, it's clear that people want to invest actively. Outside of the market and financial return, even if you never generate any alpha from your active investing, I think there's still value to learning this approach. These principles apply themselves to almost every aspect of business. Harvard Business School became the #1 business school because of its case study approach. With active investing, This is your way to participate real time with these case studies. And you can put your money where your mouth is and see if you're right. Buffett once said, "I'm a better investor because I'm a businessman, and I'm a better businessman because I'm an investor." If you have any desire to be a CEO, founder, business owner, senior leader, or executive, any sort of capital allocator, then you have to learn these skills. Studying and learning the art and science of active investing will be hugely beneficial to you. Okay, if you want to go the route of active investing, here are the steps. First, learn everything you can and do it your way. If you learn from books, then the first book I would recommend is One Up on Wall Street by Peter Lynch. It is a fantastic book on investing. If you like podcasts, then I recommend the Pivot podcast or the All In podcast. They talk about business and technology, and it'll help you get a working knowledge of the principles of investing. If you learn from the news, then I really like the Wall Street Journal or Barron's. In fact, I actually get Barron's paper delivered to my house every week like an old man. I don't recommend starting here, but you can. It's fun to read it. If none of those avenues really work for you, then feel free to join our Discord. I check it almost hourly and can check any questions, and I also post my own research real time in there. The link is in the description below. But in addition to learning everything you can, to get started investing, you do have to jump in. So open a brokerage. I like M1, but Fidelity, Robinhood, Schwab, TD, Public are all good options. And start your active investing very small. I started with tens of dollars before I got comfortable managing more. If you can, determine what % you want to manage actively versus passively. In my own life, 20% of my income automatically goes towards passive investing. This way, I learn to live on less and don't even miss it. It's always a good idea to hire a fiduciary if you're unsure of your financial footing. Once you've opened up your brokerage and have your passive side set up, then it's time to start researching companies. This is really daunting at first, but in reality, there are only 4 steps you need to hit. First, you need to understand the business. You need to understand how the business makes money, its financial health, and how they will make more money in the future. Believe it or not, this is the hardest step. Second, you need to make sure whatever business you're buying has an economic moat or durable competitive advantage. This is a business's ability to maintain competitive advantage over its competition in order to protect its long-term profits and market share. Just like a medieval castle, the moat serves to protect shareholders inside the fortress from outside competition attempting to storm it. Third, you need to look at the company's management and make sure that they are both honest and skillful at what they do. Buffett says you cannot do a good deal with a bad person. And finally, you need to assess the intrinsic value of the company and make sure that there is a margin of safety between what the company is currently trading at and what you assess that it's worth. Nothing is worth an infinite amount, and this step makes sure that the price versus value is working in your favor. And those 4 steps are really how you get started in the market. They are certainly simple, but they are not easy. Our Discord is a great place to post each step of your research and get feedback from me and other Buffett-style investors. And it helps us while we're building Flank to make sure we're building the product that you want. So it's a win-win scenario. We're getting close to launching our beta. Please feel free to check it out. Thanks so much for watching. Making these videos has been a pleasure. Let me know in the comments section what companies you're currently studying, and I'll research them alongside with you. We'll see you next time.